Hey classmates, my name is Grant Reichert and I'm going to be going over property insurance cat risk. And I'm not talking about the meowing cat, I'm talking about catastrophic risk. So if we think about hurricanes and tornadoes, wildfires, earthquakes, tsunamis, all that fun stuff, that's what we're going to be talking about today. And to start off, we're going to go over first, what is property insurance? So what is property insurance? I'm going to break this slide down into the why and the how. So starting with the why, well, property insurance is like any other insurance. It's a risk transfer mechanism, right? Transferring it from you to somebody else via an insurance contract. And what does that do? Well, it protects the balance sheet, whether it's the individual or on the commercial side of business, right? If your house burns down, God forbid, maybe you're just paying your deductible. Of course, it's a huge disruption, but financially speaking, the insurance company is going to take the brunt of that. And the same thing on the commercial side. And it also, from the commercial perspective, it helps smooth earnings. If you have a factory that burns down or gets blown over in a hurricane, instead of costing, $100 million to get it back to pre-loss condition, maybe it costs you 10 million, right? So that really helps smooth out earnings, protects cash and various other things. Now, from the macro level, it allows the economy to flourish, right? Let's go back to the homeowner example, right? If insurance wasn't in place, the vast majority of us wouldn't be able to own homes, right? It's too much of a risk for the mortgage company. If the house burns down, blows over, they're not going to expect you to pay the mortgage on a house that's not there anymore and also pay for a new house. It's not going to happen. So they can transfer that risk to an insurance company, and as a result, they'll say, "Hey, this is acceptable. I'll give you the mortgage." And think about it. It's not just us owning homes or cars or whatever it might be, but it's all the ancillary stuff as well. The people that build the homes, that maintain the homes, that fix the cars, and all that stuff, right? Without the ability for people to buy the stuff, all that ancillary stuff would also go away. And then the how does property insurance work? Well, first there has to be physical damage. That's the actual trigger that triggers the coverage. And then it's going to cover three things. It's going to cover the structure of your house or the building if it's commercial. It's going to cover most of the stuff inside it. Again, TVs and couches, or if you're a business, maybe the inventory. And then it's going to cover loss of use. If you have to go live in a hotel for a few weeks, or if you're a business and you have to rent another facility, and there's business interruption coverage and so on. So that's how that works. Insurance companies collect premium. That's their source of revenue. In addition to that, they take that premium and they invest it, usually conservatively in the bond market, and they collect interest on the investment. So most people pay premium upfront, especially if you're in the personal market. Um, but oftentimes you either don't have claims, or if you do have a claim, it's not immediately after you pay the premium. Maybe it's 8 months later, 10 months later. So they invest those premiums and collect the interest on it. So that's how the money comes in, but let's take a closer look at how insurance companies measure their performance. Insurance company performance is usually measured by a metric called the combined ratio. So the combined ratio, as its name intends, combines two other ratios, which are the loss ratio and expense ratios, into a single number. And that single number, if below 1, means the company's making a profit. If it's above 1, it means it is losing money. So the first piece of the combined ratio is the loss ratio. So think of, for every dollar the insurance company collects from you in premium, how much is it paying out in losses? Now, maybe it's for every dollar it collects, it's spending 60 cents in losses. The other piece is the expense ratio. So to get that dollar in premium, well, the company had to do marketing. It had to pay commissions to the insurance agents and brokers and so on and so forth. And maybe for that it was 30 cents for every dollar it collected in premium. So if you take the 60 cents that paid out in losses and you take the 30 cents that paid out in expenses, well, now you have 90 cents it has paid out for every dollar in premium. In this case, you'd have a combined ratio of what they'd call 90. Really, it's 0.9, but they just say 90. In that case, you'd have And this is very simplistic, but you'd have a 10% profit, right? So for every dollar that you collected in premium, you would have 10 cents in profit. So on the next slide, we're going to look at some real stats for combined ratios over the past 10 years. This slide looks at the property combined ratios for the past 10 years, and it's a little busy. There's a lot of data on it, so bear with me here. But let's just look at one year, last year, 2023. Right, so we have the loss ratio. So that was the first component of the combined ratio. And this LAE ratio, that stands for loss adjustment expenses. And that typically gets thrown in under the loss ratio. So, but it is part of the loss ratio. So just think of it that way. The other piece of the combined ratio is the expense ratio. Again, marketing, um, commissions, and so on, right? So all the way to the right here, we look and we see last year, the combined ratio is 110.5, right? Remember from the last slide that anything over 1 or 100 means the insurance companies are losing money. So for every dollar they took in last year, they paid out $1.10 to do it. So that they're losing money. Same thing with prior 2-3 years. It's like back in 2019, they actually had a profitable year. Another thing to consider is a couple slides ago, we talked about investment income from the insurance company. So they take the premium and they invest it, and then they take the interest on that, and that gets baked into the profitability. So yes, the combined ratio might be 103, but if they had a good, maybe 5% return on their investment that year, they could actually have made a couple percent profit that year. So next time, you or any your neighbors are saying, God, I had a claim, I paid premium for 10 years and never had a claim, and now my rates are going up. Well, yeah, it doesn't mean because you didn't have a claim that the insurance companies are just swimming in your profits from your premium. That's not the case. I mean, you can see here that the vast majority of premiums are getting paid out in claims, right? So keep that in mind. So what is catastrophic risk? I think it's probably easiest to first say what is not a catastrophic risk. Imagine you live in the Northeast and it's a cold winter and a pipe bursts and it floods your whole first floor. Um, right? Maybe it's ten or $20,000 in damage, and yes, it's a major loss. But from the insurance company perspective, that's what they're expecting. It's not that big of a deal. Conversely, what's pictured here is the aftermath of Hurricane Katrina. And Hurricane Katrina not only did it claim 14 or 1,500 lives, but it caused about $125 billion in damage. And I think it was about 50 billion was actually paid out by insurance carriers. Now you can imagine that if you're an insurance carrier and you have an exposure in a city such that was damaged by Hurricane Katrina, maybe you have a couple thousand homes insured. Well, now you're not just spending $10,000 per home. The entire home is destroyed, and it's not just a home; it's thousands of homes. And as a result, you take a huge hit on your balance sheet. Matter of fact, 12 insurers became insolvent as a result of this hurricane. So this graph came from data from the Colorado State University. Thankfully, they have data that goes back to the mid 1800s, showing the average amount of annual hurricanes, which is pretty amazing. But if you look back here, you start around 4, and then you fast forward all the way over to where we are now, and we're about 7 per year. Now, thankfully, most of these hurricanes, although severe, devastating, they cost a lot of money. They're not as bad as a hurricane um, Katrina, like we were looking at in the last slide. Nonetheless, again, they're costing insurance companies a lot of money. And when you have an increase in catastrophic risk, which that's what these little dots uh, are indicating, the loss ratio in the combined ratio goes up, right? Which means profitability goes down. So in the next slide, we're going to look from an insurance company's perspective, what are some risk treatment um, mechanisms that they can employ to make sure they remain profitable and their strategy is executed appropriately and all the things they're trying to achieve, they can achieve. Okay, so from the insurance company perspective, here are the main risk treatments that are available. they can transfer some of the risk through reinsurance. So that's basically insurance for insurance companies. And they can also transfer back to the insured via deductibles and self-insured retentions. Think about if you live where I do in Houston, you probably have a percent wind deductible. So instead of just, $1,000, it's a percent of your actual value of your home should it be damaged by a wind event. It can avoid the risk altogether. So in California, if you've watched the news as of the last couple of years, you see insurance companies pulling out of California because there's a tremendous amount of wildfires and liability issues and so on, but they're not able to charge a commensurate rate to make sure that they're making money. So they decide to pull out. They avoid that risk, and you can accept it. Now, of course, if you don't accept some risk, you're not going to make any money. That's the whole point of insurance, is you're taking on somebody else's risk in exchange for premium. So you need to accept risk. The other piece is mitigating, and mitigation, there's two pieces to that. There's the reduction and prevention. So you think about prevention, it's going to reduce the frequency of an event happening. So maybe you only underwrite certain structures that are, very robust. They can withstand wind events, or they're at a certain elevation above, a flood level, right? So it's going to prevent that loss from happening in the first place. Reduction is going to reduce the severity of an event. So in the commercial context, let's just say you have a building and you have a fire sprinkler system there. Well, the sprinkler system is not going to prevent a fire from happening in the first place, but if it does happen, it's going to reduce the severity. It's going to put the fire out sooner. This slide shows an influence diagram, and it depicts a situation where carrier's decision to enter a CAT, again, catastrophic exposed market, is driven by the probability of the CAT event occurring and the rebuild costs should the CAT event occur. So this directly influences the claims cost, which in turn influences the rate carriers need to charge to achieve the profit. All right, so it's just going right on down the line. So insurance companies use models, they call them CAT models, and they try to predict what the losses are going to be in their portfolio. And then they try to underwrite according to that. And many times they use a Monte Carlo simulation to help assign probabilities to these. So a Monte Carlo simulation starts by having this mathematical model representing the decision under consideration. Again, should we underwrite more or less? And what types of property should we underwrite in these markets? Is it very high CAT exposed or is it not? So then the Monte Carlo simulation, it uses random variable for the model's uncertainties to create a probability distribution. So here, this is your standard bell curve. Of course, this is oversimplified, but you've got the expected value here in the middle, and then you're going plus or minus one standard deviation or two standard deviations, and so on. So they can say, for example, if we go out two standard deviations, we can have a 95% confidence level that whatever the decision they're trying to make. So this can prove to be pretty helpful in guiding their decisions. So in closing, property insurance is quite important for us personally, and also if you're on the commercial side running businesses. We have CAT events that are continuing to increase over time, and it's not just the actual the frequency of the events, but it's the severity of them. You have a lot of more expensive property being built in these CAT areas, so it's causing a lot of disruption in the insurance markets, which is reflected in the combined ratios as they continue to increase, as we saw in the couple slides back. And if insurance companies continue to have unprofitable years, well, they're going to stop writing that insurance. So it's important for the insurance companies to take the appropriate risk control measures so they can continue to be profitable while also providing a good product in the market. And they can do this by using models and Monte Carlo simulations and all that to make informed risk decisions. So again, thank you for your time. I know that was a little bit long, but I appreciate you sticking through. Thanks.